Imagine waking up one morning and reading that the world's first AI-only billionaire just sold a tiny slice of code for billions. Not because they hacked markets or inherited wealth, but because their artificial intelligence became indispensable. Sounds wild? It's closer than you think. In this video, we'll map the exact routes that could create the first true AI billionaire, break down the real-world evidence already pointing that way, and reveal 3 surprising, high-probability scenarios most people are missing. Stay until the end. I'll reveal the single factor that makes every path possible, and why it's the same factor for winners and losers. Later, I'll name the one structural advantage that turns ordinary founders into untouchable winners. You'll want to hear this before you invest a minute of your time or a dollar of your money. 1. The landscape right now. Why this is plausible. Let's be honest, AI isn't a science project anymore. Actually, it's the backbone of multi-billion-dollar markets. Startups and labs are being priced like platforms, and infrastructure companies that supply chips and data centers are printing revenue. For example, recent fundraising rounds and reports have placed OpenAI at valuations reported around $300 billion after large funding rounds, while competitors have also raised rounds at eye-popping prices. At the same time, companies supplying the compute that powers these models, particularly NVIDIA, have seen valuations and revenues spike to unprecedented levels. NVIDIA's fiscal results and market cap underscore how indispensable hardware has become to the AI economy. Fiscal 2025 revenue figures and market cap numbers show the scale of this shift. That money creates billionaires. Forbes and Bloomberg have already tracked dozens of new tech fortunes tied directly to the AI boom. These are not always AGI founders. Many are chip makers, cloud operators, and niche AI founders whose products became mission-critical. Bottom line, the capital is here, the paydays are real, and the market is rewarding scale, data, and compute more than ever. That's why the question shifts from if to how. Which path will create a billionaire whose personal fortune is primarily AI-derived? 2. Path A, the AGI/platform founder, equity plus ubiquity. The most obvious route is the founder who builds the platform everyone uses. Think of a company that builds models so broadly useful, from healthcare diagnosis to legal summarization to creative production, that governments, enterprises, and billions of consumers pay for it. If one founder holds a significant equity stake in a platform that reaches platform status, hundreds of billions in valuation, they'll cross billionaire status in a heartbeat. Using the OpenAI and Anthropic fundraising frenzy as precedent, a high-equity founder in such a company can see their personal stake balloon with each funding round or IPO. What makes this path realistic? Network effects. The more users, the better data, the better models. A positive loop. High margins from licensing. Enterprise deals and API usage can be highly profitable at scale. Locked-in integrations. Once an AI is embedded into workflows, replacement costs are high. But there's a catch: keyman and concentration risk. Huge valuations can rest on a few people and a narrow set of tech bets. If model performance or safety issues arise, valuations can tumble quickly. That risk is real and has already been discussed in major press. Later, I'll show a numerical example of how owning just 5 to 10% of a dominant platform could create an AI billionaire, and why most founders never end up holding that percentage. 3. Path B, the hardware and chip king, compute monopoly. Another route is owning the hardware layer, the chips and accelerators that power modern AI. Companies that control the most efficient, hard-to-replicate silicon can capture enormous margins. NVIDIA's recent results show how chipmakers can capture a huge slice of the AI value chain, and execs at these firms already sit among the world's wealthiest. Why this path works? High barriers to entry. Chip design and fabrication are capital and expertise intensive. Sticky contracts, cloud providers, and hyperscalers sign long-term deals. Supply-side leverage. With limited supply and massive demand, pricing power becomes extreme. This is less about a single AI coder and more about industrial scale. The founder or major shareholder in a dominant chip company could easily be the first person whose net worth is overwhelmingly AI-derived, because compute is the bottleneck for all models. 4. Path C, the vertical dominator. Data plus regulation plus monopoly. Here's the less obvious but high probability route. Dominate a regulated vertical, healthcare imaging, legal discovery, genomics, where a single AI becomes the de facto standard because it's both more accurate and more legally defensible than alternatives. If one company gets certified, recommended, or mandated in a major jurisdiction, the scale and margins follow. Why it's unique? Regulatory moats, approval or certification can shut out competitors. Data advantage, exclusive data sets, imaging archives, bank transaction histories, make the AI better and cheaper to maintain. Switching costs, hospitals, regulators, and insurers resist churn. In short, owning the right dataset plus compliance expertise can create monopoly-like economics. That's a billionaire recipe even without consumer virality. 5. Path D, the autonomous agent/revenue sharing founder. A newer possibility, autonomous economic agents. Software that performs tasks and earns revenue for its owner, e.g., agent negotiates deals, trades, optimizes ad spend. If founders issue agents at scale or run a marketplace where agents transact and the platform takes a cut, the founder's revenue stream becomes continuous and scalable. Why this is dangerous in the good sense? Recurring revenue. Agents keep working and earning 24/7. Combinatorial scale. Millions of microtransactions add up. Platform economics. A small percentage fee across huge volumes equals massive cash flow. This model is essentially take the platform bite of every autonomous worker, and if agents replace human labor across many tasks, that revenue flywheel is enormous. 6. Risks, timing, and the one multiplier that matters. All the paths above converge on one multiplier: control of distribution. Whoever controls distribution, the routes into enterprise workflows, the channels into hospitals, the supply contracts with data centers, multiplies technical superiority into wealth. That's why investors pay for scale more than clever algorithms. But the road is littered with risks. Technical risk. Models can plateau. Promised capabilities may be slower to arrive. Regulatory reprisals. Governments may limit certain use cases or impose liability rules. Reuters and other outlets have highlighted the key man and valuation concentration risks in the space, meaning a lot of value can evaporate if leadership or trust cracks. Geopolitics. Export controls and supply restrictions can break business models overnight. We've already seen market jitters tied to hardware and export rules. Timing matters. The first true AI billionaire might appear fast, during a boom when capital chases winners, or slow after years of enterprise licensing and IP aggregation. The differentiator is staying power, repeatable revenue, and defensible moats. 7. What it would mean? Winners, losers, and the new power map. If a single person becomes the first AI billionaire via these paths, the social and economic implications are huge. A billionaire whose wealth is mostly code and contracts reshapes where power sits, from land and factories to algorithms and pipelines. Expect rapid consolidation, large platforms buying competitors, intense lobbying and political influence, protecting new monopolies, labor market disruption concentrated in white-collar sectors as well as routine work, but also enormous upside, cheaper services, personalized medicine, and productivity gains. The payoff is not purely extractive. It can create new industries. The crucial question, will governance keep pace? If laws protect competition and data rights, the wealth may be diffused. If not, fortunes concentrate. Remember I promised an example earlier? If a founder owns 10% of a $200 billion AI platform, their stake is worth $20 billion. That's billionaire territory, and we're already seeing valuations that make this arithmetic plausible. So, the first AI billionaire isn't a single inevitable figure. It's the product of technology plus distribution, plus scale, plus defensible data or hardware. Whether it's a platform founder, a chip maker, a vertical dominator, or an agent marketplace owner, the rules are the same. If you want one quick takeaway, bet on distribution and durable revenue, not hype. If you enjoyed this breakdown, like and subscribe. I publish deep dives like this every week. Drop a comment. Which of the 4 paths do you think will create the first true AI billionaire? What and why? I'll read the best answers in the next video.